Okay, we're back, and I will pick up where I left off in video 2 and talking about principles-based versus rule-based accounting standards. So the idea is, and this was talked about a lot back in around the 2005, 4, right in that range, after all the problems that occurred that gave rise to Sarbanes-Oxley around 2000, 2001. Shortly after that, that became a hot debate. Um, right here, July 2003, I just spotted that. That was part of the report that came out with Sarbanes-Oxley and started the debate about this principles-based versus rule-based standard system. Now, as I said, U.S. GAAP has traditionally been very rules-based. If this and this and this is true, then you account for a transaction this way. You can think about if you planned to hold a debt investment and you have the ability to hold it to maturity and you plan to hold it to maturity, then you account for it as held to maturity. That's a rules-based approach. Now, a principles-based approach would be something more like if you plan to hold the investment, the debt investment to maturity, and you think you have the ability, then the proper accounting would be held to maturity. And if you're not actively trading it, but you might sell it before maturity, then it would be available for sale. And if you were actively trading it, then it would be a trading security. And no real rules to direct you on what those things mean. Now, instead, we have the rules-based approach, which sets out specific rules that if this and this and this are true, then you do it a certain way. Now, people argued that if we had a principles-based system, that would, that would require more judgment and better judgment would be applied. Now, my way of looking at it is if we were face to face in class and I hand out a test and I tell you, okay, the principle is no cheating. You're not allowed to cheat. Now, it's up to you to decide what's cheating, but I'm going to be looking around, and if I see something I don't like, then I may act upon it, but I'm holding you to a standard of saying, I don't expect you to cheat. Then the other alternative, a more rules-based approach, is what I take of saying, hands above the desktop at all times, test hands, everything stays above the desktop, cell phones off and put away. If your cell phone is out or it's on, you're cheating. That's a rules-based approach. Now, you stop and think for yourself, which one is more likely to be successful at preventing cheating? Now, you can decide what you think is best. I think a rules-based approach works best. It does set out specific expectations and specific requirements. Now, a lot of times you hear the argument, well, what companies do then is study the rules and try to set up transactions in such a way that they get around the rules and allow the transaction to be accounted for as the person setting it up would like it to be accounted. Well, if they're following the rules, then my opinion is that's fine. Now, with a principles based, you just say, well, the principle is, generally speaking, you should do this, but it requires some judgment to decide between A and B. Well, now I don't have to worry about how I structure it. I can just say, well, in my professional judgment, it should be B, which is what I want. And it's a lot harder to argue with that. So I don't toe the party line, which means I don't just do what they say, and I don't believe everything the FASB says. I believe a rules-based standard set is by far preferable to a principles-based set of standards. Now, if we were in the ideal world where everybody is completely honest, then a principles-based approach might be better, but we don't live in that world. We live in this world. In this world, a rule-based set, I believe, is better, but you can decide that for yourself. Now, I talk a little bit about comparability here and get into ethics in accounting. Now, we accountants pride ourselves on the fact that we are a profession, but you might ask yourself, what makes some profession rather than a job? In other words, how do we make sure that we are a profession and not just a vocation that people have? Well, there's a few things that go into a profession. One is commonly a set of ethics. You know, a profession usually has its own set of ethics, which we do in accounting. And, the difference between laws and ethics. Laws tell you what's legal. Ethics tell you what's right. And generally speaking, ethics are more demanding than laws are. Now, I'll give you an example of the difference between laws and ethics. Let's say you're graduating with your degree and someone offers you a job. And so you accept the job and commit to go to work for them. And then a month later, before you have started work for them, somebody else comes along and offers you a job paying more. So I've actually had students that were faced with this dilemma. And the question becomes, well, what should I do? Should I take the new job and call the first employer up and tell them, well, I changed my mind and I'm not going to come to work for you, which is legal. But is that right? Well, my answer to that is no, it's not right. And that's unethical and you shouldn't do that. Now, are you violating any laws if you do it? No, you're not. But you're doing something that you and I both know is wrong. So they give you a lot of discussion about ethics, and you need to study the code of ethics, but an ethical dilemma occurs when? Well, my answer to that is when you want to do something that you know is not right. That's an ethical dilemma. When your best interest is to do A, but your conscience tells you that doing A is really not doing right. And we'll go back to the accepting a job. You know, you interview with somebody, they're really excited about you. They want you to come to work for them. And so they offer you a job. And you are excited about going to work there. You excited about having an opportunity to start your career, and you accept on the spot. And then a month later, you get a better offer. And so now, what do you want to do? Well, the answer is you want to change and go to the job that pays more. But what's right? Well, what's right is to honor your commitment, to be a person of your word. And so an ethical commitment or an ethical dilemma occurs whenever you want to do something that you know down deep in your heart is wrong. And so when you face an ethical dilemma, my rule is it's really simple. Just do what you don't want to do. You want to back out on that job you accepted and accept the other job. You know that's wrong. So do what you know is right, not what you want to do, what you think is in your own best interest. And by the way, you'll be amazed how often when you do what's right, it winds up working out for the best in the long run. And whenever you turn that job down, you call the person back and say, I changed my mind and I don't want to go to work for you. I'm going to accept another job. You never know where that's going to come back to haunt you at some future point. That may be pop up and cause you some problems. So be ethical. By the way, another thing that makes a profession is when you have a profession when you do something that others can't. And so what is it that makes us a profession? Is it that we do taxes? Well, the answer is no. There are lots of others that can do taxes. You don't have to be a CPA to do taxes. Enrolled agents can do it, who are people who have taken a test with the Internal Revenue Service and shown that they know a lot about tax. Lawyers do tax. We have tax lawyers. But auditing is the thing that makes us a profession. Only CPAs can render an opinion, an audit opinion on financial statements. Okay. Not really going to talk about this analytical model for ethical decisions. It's not bad. It's good. It's, well, let me go ahead and talk about it a little bit. What do they say? Well, number one, how do you make the right decision, the ethical decision, determine the facts of the situation, identify the ethical issue and the stakeholders, then identify the values related to the situation, specify the alternative courses of action, evaluate the courses of action specified in step 4 in terms of consistency with the values identified in step 3, identify the consequences of each possible course of action, and then make the decision and take your indicated action. Now, you want to make that simple? Just do what you really do not want to do. You want to do something, but you know you shouldn't, and that's why you have an ethical dilemma. Okay, that gets us up to the conceptual framework, which is where I want to spend most of my time for chapter 1, although I probably won't spend much more time than I spent on the first part. But we have a couple of minutes left here in this video, so let me go ahead and jump into it a little bit. Conceptual framework is a set of accounting statements, right down here, statements of financial accounting concepts that the FASB came out with. Now, they're commonly referred to as the concept statements. But FASB issued those over really a very long period of time. SFAC 8, Statement of Financial Accounting Concepts 8, which was the last one issued, came out around 2010, I think. Now, given that the FASB has been around since 1973, it's pretty amazing, and 7 was issued in the late 90s. So, are we done with the concept statements? Well, I think so, but who knows? I thought after 7 came out, we were done, and I thought after 6 came out, we were done. It was a good while between 6 and 7 as well. So, those do not create GAAP. Instead, they are creating a framework for how the FASB will go about determining GAAP. And so they set out these broad concepts of what financial reporting should be. Now, early on, the concept statements identified that one of the things that should be present in financial reporting was a statement of cash flows, and that was long before the statement of cash flows existed. And so we kind of knew that they were eventually going to address that. SFAC 7 actually came in and set out the idea of the statement of cash flows and how it should be presented. And then Statement of Financial Accounting Standards, I think it was number 169, if I remember correctly, actually spelled out the statement of cash flows. but he's kind